Hello, welcome to FNArena Talks. I'm Danielle Ecuyer, and I'm very excited to have today joining me from New York, George Noble. George, welcome. Thank you so much for joining us.
Thank you for having me, Danielle. It's a real pleasure.
No problem at all. So, George, for the Australian audience, which we predominantly work for or provide a service to, can you give some background? Because you have quite an amazing history of work experience and knowledge.
Flattery will get you everywhere, Danielle. As you can tell by my gray hair, it's not my first rodeo. I've been in the industry since 1981. I was fortunate enough to have started my career at a little company called Fidelity in Management and Research, which became Fidelity Research. With now 18 trillion under management, back in the day, they had, you ready for this? $8 billion under management.
Mm.
Only 3 billion in equities. I was a summer student in 1980. I'll just give a little bit of history only because the context is kind of interesting. Fidelity had a tradition of only hiring two summer interns, one from Harvard, one from Wharton. And if each summer intern was offered a permanent job and came back, they didn't hire anybody else. They only had two people a year. Fidelity came through a period in the 70s where, believe it or not, they actually had lost money. They had layoffs. Their exciting new product that actually sustained the company was the money market fund. They were the first ones to have a money market fund. I went to work summer of 1980, permanently in 81. The Dow was at 800. As Ned Johnson used to say, never confuse brains with the bull market. So I was in the right place at the right time. Yeah, I work hard. I'm not stupid, all that kind of good stuff. But you also have to be in the right place at the right time. Malcolm Gladwell, please call your office. I grew up in the 80s, was an auto analyst. I famously was the auto analyst when Peter Lynch went to Detroit and visited Lee Iacocca and Chrysler. I was in the room, I carried his bags. I knew enough to shut up, though, and listen in the presence of greats, you might learn something. And when they made me his research assistant, and then subsequent to that, we started the Fidelity Overseas Fund. Believe it or not, in 1984, they didn't even have a foreign stock fund. Ours, the Overseas Fund, was the first foreign stock fund. And this was both a blessing and a curse. The first year I managed money in 1985, the fund was up 79%, the number one fund in the country. The fund grew from 0 to 3 billion, when 3 billion was a lot of money. To put it in context, Magellan was only 5 billion at the time. That was 1986. I was there for 10 years. Went on to start a couple of hedge funds in the 90s and the 00s. Closed my last fund in 2009. Happy to talk about that. Had a little foray with an ETF in 2022, which ended disastrously. Always learn more when you screw up than when things are going well. And so, what am I doing now? I'm a presence in social media. I kind of view investor education as my thing. But as opposed to a lot of the nonsense and bloviation that you find on X and elsewhere, I bring the receipts. I bring real content to people. You and I have a good mutual friend, Michael Howell, who I've known since the 80s as an example. That's the type of caliber of content that I bring. I have a very large Rolodex. I do investor conferences. We had an online conference a month ago, had 800 people in it. And by the way, this is not macro sports talk radio nonsense. This is name names. What should people buy? What should people sell? And so it was a spectacular conference. We had 15 people, 15 ideas, 7 hours, only $99. It's crazy. It had 800 attendees. We're having a conference in May, a conference in June. We're going to have 2,000 at least, I believe, in attendees to that. So we really are democratizing finance, but in the right way. I'm trying to teach people what I learned. I was fortunate to learn from the greats. I'm trying to pass that on to folks. And yeah, I do. People can find me. I'm on Substack. I'm on YouTube. I'm on Spaces a lot on X. I have 98,000
Okay,
followers on X. So
George.
so I'm all over the place. As you've already stopped, and as I already figured out, and I'll stop very soon. I like to talk. So there you go.
I just before you give away all the secrets of where everyone can find you, you touched on a point that I think is really important because people like us who've been in the markets for a long time, managing money, in my case, it's my own personal money, but we've seen markets change dramatically over the years, and we can't go through every example, but certainly it looks as though COVID was a point in time where technology collided with so-called democratization of markets, where you've seen a lot more retail people coming into it. So let's drill down maybe a little bit into that point, because investors now, whether you're in Australia or whether you're in Timbuktu, you can basically invest globally, which creates a whole lot of different dynamics through different financial products, potentially increased volatility, etc. How do you, like, I look at the markets at the moment, and in a nutshell, sometimes I feel completely flummoxed. I mean, the volatility, the noise, it's kind of like a crazy, like you would describe sometimes as a casino. How do people break down all this noise at the moment? I mean, do fundamentals still count, or has it become something that switches from factor investing to momentum investing to just ETF flows and liquidity? Because to me, it's like this grand melange that is sort of bubbling underneath the surface. How do you see it, George?
You touched on a lot of important aspects of markets today. They're much different from when I was growing up. There's so many strands to pull on there. Let's first start with just the character of the markets, who's doing the buying and who's doing the selling. Um, Back in the 80s and the 90s, real money, mutual funds, pension funds. Then we saw the ascendancy of hedge funds. That was really what I would call very fundamentally based investing. People would look at earnings, valuation. There was a reward for doing deep dive fundamental analysis. Um, Comes to mind the so-called hunter-gatherer model of investing. I know something you don't know. Namely, I talked to the company and I found out something. And some might say that, the likes of Fidelity made a business of arbitraging non-public information. You could talk to companies, they would tell you things. But then with the rise of Reg FD, 2000, 2001, companies were restricted in terms of what they could say. So the lawyers and the investment bankers kept them in line. So your edge was greatly diminished. And that coincided with the rise of the internet. So the half-life of the utility of any piece of information you might have became diminished. So you'd know something, you'd act on it, then you might tell somebody else, and it goes around the internet. And so the next thing you know, that bit of information, excess return from that bit of information is arbitraged away ever more quickly. So you have Reg FD. You also have the rise of passive investing. As we all know, active investors have been on their back foot, losing assets to passive. And there are good reasons for that. First and foremost, passive investing is much less expensive than in terms of fees. If you can go to Vanguard for 5 basis points, why would you pay a manager 100 bips or whatever you're paying them? So that's one. But also two, we've been in a market where it's very unusual. And Danielle, I know you go back way back in fundamental investing, but there was used to be the law of large numbers, and company gets big, market cap gets big, all things being equal, which they never are. You'd want to shy away from those things because the marginal return on capital of the biggest guy would be far less than the marginal return on capital of a well-run small company. But what's happened with these large cap names with the network effect and networks and the hyperscales and all this sort of thing, if you can't scale in this world, you're dead.
Mm.
And so it's kind of the opposite of what I grew up with in the early 80s from a fundamental perspective. You didn't ask this question, but I'll answer it anyway. Um, the way markets are set up right now, and Peter Lynch is the GOAT, in my opinion, the greatest of all time, and then we can get into why. Markets are not set up in a way to breed future Peter Lynches. Market structure, the value of deep dive analysis, it's not what it used to be. Say one funny story. Says, I'm on Substack now. So I wrote we've written a couple of reports. I wrote up a gold mining stock and airline. So anyway, in June, I wrote my first stock report. It was Southwest Airlines. I'd heard the stock idea pitched at a conference a couple months earlier, and then something caught my eye where, I don't know, Elliott Management got involved, whatever. And so I looked at the chart. The valuation on EV to sales is a third of Delta or United. That's because their profits are de minimis. But you've got Elliott Management in there breathing down their necks. Chart looks good. That cost cutting thing, they're starting to charge for bags and get rid of the middle seat, all this kind of stuff. So I'm like, you know what? This actually looks like a pretty good idea. So I wrote it up. No 30-page TLDR type thing, but there's the efficient frontier for just how much information is enough. If you write a one pager, you know Daniel from your BZW days and back and back. If you just wrote one page, it's not enough. If you write 30 pages, no one's going to read it. So 4 or 5 pages, and I modeled it after what's known as investment committee report, an ICR. I went down to the basement. I got my boxes from a report I'd written in 1983, and I said I'm going to make it like that. So I put in, what the company does, the elevator pitch, strengths, weaknesses, opportunities, risks, balance sheet, cash flow, income statement, short position chart, catalyst, all that kind of stuff. 3 or 4 pages. And so I show it to my shadow partner and he kind of laughs at it. He goes, "What's that?" He goes, "Nobody writes reports like this anymore." I go, "Yeah, exactly. That's why I'm going to write them this way." Okay. It's back to the future. We're going back to where we were. That has been so lost because nowadays, you know how it is, Danielle, that people want to know what's the story and they want to look at the chart, they want the narrative.
Mm,
Valuation? Oh, is that a thing? So I think we're really at, we're the market inexorably and inevitably is making its way back to fundamental investing. In a world where you make the cost of capital free, pigs will
mm,
fly. Actually, the junkier the company, the higher the beta, the more ample liquidity. Our good friend Michael Howe will piss us off to no end. He's like, I pay no attention to valuations. I just look at how much money is there in the world and it's all going to go up. And the junkiest crap will go up the most. So the character of the market's changed enormously from a fundamental perspective. But there's another very important way in which you ask, with this, what's this deceivingly such a simple question, but an excellent question because it's like it's not your grandfather's stock market anymore. It really isn't. As my friend Stavros says, there are the 3 V's. What are the 3 V's? I should have led with the 3 V's. When he told me, I said, yeah, I should lead with this. I have the 3 V's. And it's talking now about information, the volume of information you get, Twitter, news reports, Yahoo Finance, blah, 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 blah. So the volume, the velocity of the information, it's like a fire hose, and the variety. Jay Pulaski, formerly the emerging market strategist for Morgan Stanley, now has his own boutique TPW advisory. And this is not a political statement. It captures the essence brilliantly. When I was interviewing him last year, he said, "Gee, George," he goes, my superpower is to ignore everything that Donald Trump says." And he said that it has nothing to do with whether he likes Trump or hates Trump. It turns out he hates Trump, but leave that aside, it's irrelevant. And he makes a good important point. He goes, Trump is a volatility generating machine. Okay. Okay. So it's like a random number generator. My dad was a mathematician. Whatever he says one day, odds are tomorrow will be exactly the opposite. So what you need to do is keep your eye on the prize. Stay to the fun. Know Peter Lynch famously, know what you own. And with all the talking heads on X and with all the volatility, it's up one day and down the next day. It's easy to get distracted from that. And it's just really hard. So if you're having difficulty, Danielle, I can assure you, you're not the only one. You think pros are having an easy time of it? Look at how screwed up hedge funds are. So we're really in a very unusual period of time. One last point I want to make on this, there's a lot more I could talk about, but we've been, I'd say starting around 1998, 99 with Y2K. We had Asian Contagion in 98, Y2K in 99, 2000, the dot-com bust. Alan Greenspan, I don't know if it's Alan Greenspan or Ben Bernanke. I don't know who's done more to destroy America than either of those two gentlemen. And turning on the fire hose and printing so much liquidity and just pushing asset prices up. And in a world where one perhaps is increasingly constrained by fiscal limitations, all they know how to do is ease. And the extent to which asset prices are targeted it really kind of makes less important the fundamental side of things. And so, in a world where everything goes up, yeah, just be a retail investor, not to demean retail investors, but you want to buy some quantum computing stock on 300 times sales or an electric car company that should not be named is $1.4 trillion market cap. And do you know, Danielle, you knew this was coming. I couldn't resist. You were just wanting to see how long it would take. But don't worry, I'm not going to mention the name unless you ask me. An electric car company with a market cap of $1.4 trillion, which cumulatively since inception has made a grand total of $38 billion. Like, in what universe does that make any sense? So this speaks to irresponsible monetary policy, narratives, as Jim Chanos would say, legal fraud, companies
Mhm.
being, how shall we say, economical with the truth. And so I don't think it's going to end well. And so, it kind of is like the stock market you grew up with, but sort of like a haunted house of a stock market where the mirrors are making it look weird and everything. So it's not business as usual. And I think most all pros have had to change the way they do business. Many have gone out of business. But this too shall pass. And I actually think that within the last year, we've started the road back to where we were. From 81 to 21, we had 40 years of declining interest rates, falling bond yields, rising valuations, returns to capital got the upper hand of returns to labor in a very significant way. Disinflation or deflation was the order of the day. That's now in the process of changing. I think, as I say, Danielle, was it past results, no guarantee of future returns or whatever. I think we're looking at an age where commodities are doing incredibly well. I think bonds you should run, not walk from bonds as quickly as you can. Michael Howell, I'm sure, has spoken to you about that a lot. I think the AI trade represents the biggest misallocation of capital in the history of the world. I think you should avoid tech. So it's very different. And what I find delicious, and I'll land this plane, just at the time when everyone's been told, oh, you have to have an index fund, you got to be 60/40 and this and that, and you got to be in the S&P and blah, 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 blah. It couldn't be. I'm gonna pull rank on you, my BZW friend. This kind of reminds me going back to late 80s, early 90s in Japan. You know, um, Japan, as you might recall, at its zenith, got up to 66% of EFA, the Europe, Australian, Far East Index, the non-US S&P, if you will. And so I was managing a mutual fund, the Fidelity Overseas Fund, where my benchmark was that index. And therefore, you know, you had to be wary of the fact if you didn't have 66% in Japan, you're making a bet against Japan. In the same way, if you don't have 40% in tech, you're making a bet against tech. So you had, the Japanese market on a multiple of 60, financial stocks, which were 30% of the Tokyo index, were on 10 times book, 100, the bank's 10 times book, 100 times earnings. And, by comparison, Japan was 66% of EFA. I think Hong Kong was 1.5%. Australia was like 4%. Like, who cares? Like who care? Why waste time in Hong Kong or Australia? It's nothing. Do you own enough Nomura? That's the real question, all right? So in the same way, you look at the US now, it's like, you got the Mag 7. They did incredibly well for a decade or more. And we know why. Their sales and earnings went up. And as Peter Lynch would always say, in the long run, on average, there's a correlation between profits and earnings. Lately, with some of the more speculative stocks, not so much, but in the long run, on average, that's the way it works. And so, Mag 7, the hyperscalers did it incredibly well. They crushed it. Secular growth, strong cash flows, powerful moats, blah, 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 buying back stock. Now that's all changing. They're spending money like crazy on this AI thing, the free cash flow profile, these things is imploding. Um, there's signs of life in the 493. I mean, it wasn't just that the S&P and the 493 also become like proxy for the rest of the world. It's all the same trade. Before you had such spectacular earnings growth in the Mag 7 and the 493, not so much. Now that's changing. When growth is scarce, you pay up for growth. When growth is plentiful, you do not pay up for growth. And that's what we're seeing right now. So I think we're in an age where you should try to get as far away as you can from indexing to the S&P. I think tech has done its thing. So things like material stocks with your Aussie audience, gold stocks, energy. Um, Dennis Gartman, he's in poor health now, but he used to have a saying, you want to own things which if you drop them on your foot, it will hurt. Okay. Little microchips, not so much. So anyway, so you asked a simple question. I rambled on for 10 minutes, but there you have it. Next question, please. I probably
Well,
didn't answer. Go ahead.
George, there's so many things wrapped up in there, and we can't sadly touch on everything. There's definitely, for people to understand, the dislocation that's occurred because of, as you said, the money printing, the financialization of the world, the amount of debt that's come into it, and it's created this asset class boom at the expense of the worker, which has created massive inequality. And we won't go down that whole narrative of the political implications, but clearly that's what's playing out at the moment. I think what you touch on is really interesting because this war, every war, like the invasion of Ukraine, it was like a massive shift geopolitically that we hadn't seen for many, many years. I and you have been very lucky. We've lived in long peacetime, very prosperous times. As you say, we've had luck as well as working hard to achieve success. But it's almost like there's this tectonic shift going on where the paradigms that have existed for 50 odd years seem to be shifting. And certainly from an Australian perspective, what's going on now with the war in the Middle East, and I want to call it a war because it's not just a
Sure.
conflict. Um, Australia like many countries, has exposed the underbelly of vulnerabilities. And it's like COVID did that as well with supply chains. And I, having never been a resource investor, actually concur with you. We don't give advice at FNArena. I cannot give advice,
Hmm.
but I concur with the thing that this whole global scramble towards getting energy resilience, getting energy security, getting all supply chains secured has only been re-emphasized with this war. We'd seen it in COVID, and if politicians didn't get enough of a shock then, they're getting a huge shock now. Because Australia,
Hmm.
like many countries, we're just laying bare. We have two refineries that are almost conked out, and we import all our diesel. We don't do enough refining, and we export all our LNG, and we're one of the most, resource-rich countries. So I tend to agree with you. The one thing maybe we can touch on, because again, I've probably talked too much, is if we get a rising interest rate environment, George, how do you balance that between the huge amounts of debt in the world? If the politicians and the central bankers didn't let the system go in the GFC, how can they possibly let any systemic events occur now? Because you the magnitude of the effects would be that much even greater than back then. So how does the world manage with higher interest rates? And are we talking ridiculously high, or are we just talking we move from, let's say, 2 to 3% or zero up to 4 to 5?
Again, deceivingly simple. You ask these very deceivingly simple questions, which are incredibly complicated. And we really should have Michael Howe here. So I'll try to do my Michael Howe imitation. So Charlie Munger, who passed recently, Warren Buffett's longtime partner, he had a great line, many great lines. One of them was, "You show me the incentive, I'll show you the outcome." So you just laid out the problem. Um, they need to be able to issue more debt because there's no constituency out there for fiscal rectitude. And so how do you do that? I mean, my concern is that we're heading inexorably towards a sort of Liz Truss type moment where the market's going to say no mas. You recall back in 22 where the markets revolted against the budget and pound sterling collapsed, the gilt market collapsed. With respect to my British friends, the UK is an irrelevant little island. Now we're dealing with the US, which sets the policy for financial markets globally. Um, so I think I'm no economist, although I did study the dismal science at Yale. I can BS with the best of them. So they're going to keep spending more money, which means more debt, more deficits. It's particularly alarming that the deficit's gotten as large as it has when economic times, okay, they're not great, but we're closer to a booming economy than we are. So $50 in double jeopardy, explain this. Tell me what happens to the deficit when we finally get a recession. Danielle, I'll wait. Okay. So, we're running a deficit of 7% of GDP like right now. And so we had this incredible blowout in the deficits because of COVID. Okay, fine. They spent an irresponsible about amount of money, but it should have been a one-off. Should have gone back to where we were before, but they didn't. Again, there's no constituency for cutting spending.
Mm,
So they keep spending more money, have to issue more debt. They can't let the bond yields rise much. As we know, interest expenses, I think the single biggest entry, in the spending. So as Mr. Howell keeps reminding us, he's been consistent. We're looking at financial repression. They already stopped the QT a few months ago. They're now funding everything at the short end of the curve, irresponsibly, in my view. I mean, Danielle, I don't know where Nick Leeson is, okay, but you were at Barings back in the day, okay? If you had a rogue trader and he has to have his maturities matched, and you and I are the managing directors, we're on the risk committee, and we find out there's this guy who should have had matched maturities, and guess what? He didn't want to pay up for the long end, so he funded everything at the short end. You'd be like, what?
mm,
What? This is what Bessen's doing.
mm,
Hey, but hey, what are you worried about? The S&P just went to a new all-time high in the 10 years at 420. Like, what's the problem here? I don't see any problem. All right. So, this is not sustainable. And I think, particularly set against the backdrop of a lot of other things you pointed out, the increasing geopolitical upset, the U.S. is not exactly making a lot of new friends the way they're conducting policy right now. It used to be okay. Maybe you didn't like the U.S., but if you're Saudi or the Middle East, you'd be willing to pay for protection, like we're in the mob. We got your back, all right? Well, now all of a sudden, these $10,000 drones can take out like a $10 billion battleship. Okay, it's like, what's with that, right? So I think U.S. hedge money is a borrowed time. For those who say the dollar is going to go away, no, it's not going to go away. I'm not one of those. But I think all paper money is being devalued against real things. Let's just use gold as the unit of account. And so, trying to figure out whether the dollar's going up against the euro or Aussie or whatever, it's irrelevant. I mean, last year the dollar was down, I think, 9% against the euro. That's what good. Excuse me, gold being up 60% and silver being up 130%. Like, what are we wasting our time looking at the euro? It's like not interesting. By the way, sidebar, I did notice in Michael Hartnett's thing this past weekend, it showed Aussie yen going to like a multi-year high, and the chart looks fabulous. So that chart speaks to me. And so, they can't let their rates go up. They're going to engage in yield curve control. And I think they're going to keep spending until the adult in the room says no more. And the adult in the room happens to be Mr. Bond, Mr. 10-year
mm.
bond, not James Bond, Mr. 10-year bond. And we may get one of these situations where, the 10 years at 430. What if I told you at the end of the year it's 510? I'm not saying Weimar type numbers. Let's not get hyperbolic. But I think one theme here, and you really should, I don't know if you know Russell Clark, Aussie refugee. He's now a very successful hedge fund manager in London. I'll make an introduction for you. But his theme has been rising cost of capital globally, and I think that's what we're looking at. We're just spending money, spending more, more, more. As I say in FinTwit, Danielle, more, MOAR, MOAR. I mean, it's almost enough to make you think that MMT was legit. These crazies just saying, "Oh, you spend as much money as you want; it doesn't matter." And Trump's probably sitting there saying, "Hey, I liked it. That's good. Do more, Scotty. Oh, just keep borrowing more. No problem." Well, this is not going to have a happy ending, Danielle. You know it, and I know it.
Yeah, it's really interesting because you are seeing it playing out in hard assets as well. And Michael Howell and
Yeah.
I, had that conversation about even Australian property, particularly in the major cities, Sydney, Melbourne. We're really seeing big international buyers coming in here. It's a safe asset, assuming.
You have a dirt cheap currency. I mean, I'm
Yeah.
sure the housing prices, I mean, they're legendary how expensive they are, but if you're looking around the world,
Oh, it's
think about this,
relatively cheap. It's
relatively cheap, okay? Just
yeah.
like New York's relatively expensive, okay? And the other thing too, it's not that people are running to Australian property prices or they're running to gold. It's they're running away from paper money, from fiat currency. I have to, like, how do I step out of how do I step out of the financial system? Gold again is one of the few assets out there that is not somebody else's liability. So it's like, those green, I don't know what color your money is in Australia, but these green pieces of paper we got here, they're going down in value every day. So it's not that the price of gold is going up. It is going up, but it's the value of money is going down. I did a little Rorschach test. I was at a conference last fall, and I had fun with the audience. I put up three charts. First was a chart of the U.S. bond market, the TLT. And I said, well, what do you think of this chart? And they looked at it. They said, well, all you know is a chart. What do you think? They said, well, it crashed. It's now doing nothing. And, it crashed, but it's not bouncing. It's kind of like going sideways. It's not doing a whole lot. So if you were an amateur technician, be like, I don't really like that. I know, Danielle, you're a momentum player. We all are momentum junkies at a certain point, right? So you'd say, there's nothing going on here. I don't like that. Okay, fine. Then I put a chart up of the U.S. bond market, the TLT, but I denominated it in Turkish lira, which is like one of the most worthless currencies in the face of the planet. So it's TLT divided by Turkish lira. And it's steadily, relentlessly going from the lower left to the upper right. It was like, and I didn't tell them what it was. So you go to the eye doctor. Do you like it better this way or this way? Right. And basically, it was the TLT divided in Turkish lira. Everyone's like, oh, that looks great. I want to buy that, whatever that is. And then I put a third chart up. I took the TLT and I divided it by the price of gold. It was crashing. It was going steadily from the upper left to the lower right. And I go, what do you think of this? They go, that's terrible. I said, so let me get this straight. The first one you don't like, the second one you really like, the third one is a disaster. You short it. I said, yep, yep, yep. I said, boys and girls, ladies and gentlemen, it's the same item. It's just the unit of account is different. The first one, we're measuring in American pesos. The second one, we're measuring in Turkish lira. The third one, we're measuring in gold. What is it they say? Gold is money. JP Morgan, please call your office. Gold is money. Everything else is, credits, useless, whatever. So it's only, so again, it's a money illusion. You're sitting there, probably the same thing's true in Australia. Oh, I don't know, you own your 10-year, whatever the heck it is. Oh, it's not so bad. I'm getting a coupon, yada, yada, yada. Okay, fine. I'm making my 4%, 5%, whatever. It's only one problem. The thing that you're holding, the thing that you're holding is going down in value in real terms. So it's kind of like boiling a frog, it's sort of like everyone just stays in the pot, nobody jumps out. So go back to your question about, what are they going to do? They will, they can't let the nominal interest rates go up very much. They'll engage in yield curve control. Michael House forgotten more about that subject than I'll ever know. And I'll just end this question with, reminds me of Alan Greenspan in the late 90s in front of a congressional hearing. They asked him, they said, well, is the U.S. going to run out of money? Like, how can you guarantee you're going to be able to make Social Security payments and all the rest? And in classic Greenspan fashion, he said, well, I can guarantee you we're not going to run out of money. That I can promise you. However, I cannot assure you as to what the value of that money will be. Okay. All right. And that's kind of where we are, in my view.
Indeed. Okay, against that backdrop, I think your point about a rout in the bond market is really interesting because equity investors often forget that the big boy in the room, the big trillion dollar elephant, is the bond market. And if you do get a sell-off in the 10-year, that really will spook equities. And that's one thing possibly to have on your just watch out,
Right. And,
horizon.
I did a space the other day. You may have heard it, but the question I asked is a great question I always ask people. What are markets concerned about now they really shouldn't be concerned about? And what are markets not concerned about now that they should be concerned about? In other words, 3, 6 months from now, how Mr. Market's worry list is always something to worry about. How's that going to be different 3, 6 months from now from today? Dial the clock back 6 months ago. Everyone was assured of getting into a pissing match, a bidding contest. How many rate cuts are we going to have in 2026? Well, how did that work out, right? Okay, all right. So, um, Russell Clark made the point to me. It's a good one. He's been very big on this long gold short TLT trade, and it's printed like crazy. Last few months, gold got over its skis and it came in. It's down 10, 15% from the highs. No big deal. Bonds have gone nowhere. So for a lot of people, they're like, okay, Russell, yeah, this gold TLT trade, it's worked really well over the years. But hey, it's still going to work. But you know what? It's really the gold side of the trade which is working. The TLT, the bonds, it's like nothing. It's not going up. It's not going down. So, forget it. We'll put on the old Texas hedge. Forget about the short side of the trade. We're just going to put on the long, be long the gold. And Russell's like, it's classic. It always works this way. nobody wants the short bond position right now because it hasn't done anything lately, okay? But if if ahead of the midterms we get more spending, and if somehow wave a magic wand, I don't know what's going on with Iran, your guess is as good as mine, that starts to diminish. And if we get more easing, think about it. Like gun to head, like, okay, maybe you don't want to be short bonds right now, but you want to be long them? Are you kidding me? And so Russell's whole point was he's like, gold is entitled to a rest. Maybe it'll go down, who knows? But his concern is the biggest concern for the gold trade right now is if we do get bond markets, if we do get interest rates starting to really go up a lot, that could pressure the gold price. So I really like the idea of not just being long gold, and particularly the miners, belong to miners. I always like to give people actionable advice, not just bloviating. Like, I think they got no. What should investors do right now for the people who are watching this video? Buy gold and silver stocks hand over fist. Okay, that's my favorite trade far and away. So you say, well, George, what could go wrong with that? What could possibly go wrong? It's interest rates going up in a material way from here. They go to ease, they go to cut rates, whether they will, they won't, I don't know. Let's say they do. Comes in, he's a new guy, they'll cut rates. I actually think they cut rates. I actually think bond yields are going up, not down, because people are going to say that's irresponsible policy. And so, I'm not calling for Weimar type interest rates like you were asking, but to start the conversation, if you said, okay, we're in Vegas, what's the over under? George, spitball with me. Where could rates be end of the year, 2 years from now? I think the U.S. 10 years grossly mispriced. Just to start the conversation, you should have a five handle on it, not 420. I'm not going to go as far as Russell and say that 10% long bond is the answer, but there's you can understand the logic because if we want to do away with wealth inequality, I know we're not going to go down that rabbit hole, but the housekeeper needs a big pay increase. Well, if we start getting generalized inflation that's higher bond yields, the money class, the 10% of the population that owns all the assets, they're not going to like that. So every time they start to let yields go up, it's like the asset prices crash, they have to stop. So we're kind of stuck in this weird situation. So, but no, I would run, not walk from bonds. I'd stay away from US tech. I own miners. I own energy. It's a very different world. The next 10 years, in my opinion, are not going to look anything like the last 10 years, but more relevance, like right here, right now, 2026, the market's already shown you. I mean, listen, it's crazy. We're recording on a day today where the market's been up like 13 days in a row or something crazy, the NASDAQ, and you've never had going from so oversold as measured by the RSI to so overbought. You and I read the same stuff. This too shall pass. I mean, there's a huge squeeze. People positioned wrongly. I don't focus on the day to day, the week to week. And when I think about markets, I'm looking at the other way how markets have changed. Do you think Peter Lynch or anybody at Fidelity would sit around and try to predict the market on a weekly basis and measure their performance weekly? Are you out
Hmm.
of your freaking mind? Okay. But this is what retail investors do now. And so I promise you they're going to get an education. The only question in my mind is whether it's, as my father always would tell me, you can get an education by precept, by reading about it in a book, or you can get an education from Mr. Market. And I promise you, the first one's a lot cheaper, but we're all human, and inevitably, we all insist on getting our education from the latter, not the former.
Indeed, indeed. And you don't forget those big lessons, that's for sure. Tell me,
Mm,
looking at the gold and the energy stocks, really interesting. There's going to be a lot of, there's already been political moves here in Australia to
mm.
ease up regulations around exploration, drilling. What about the argument is like, yes, energy is going to look really good, but if we do have, let's say, a global drill baby drill, and we're going to take the ESG out of this at this point in time, what does that do to the actual oil price? So some people would argue, well, that's all well and good, but as soon as you get more oil coming onto the market, it's going to depress the price. They're not as profitable. Or is there a nice, excuse the pun, sweet spot, sweet crude in between, where you actually get these companies that just actually Some good performers. First question. Second question, if you are looking at the energy sector, do you go for the big boys? Do you go for, I'm just going to throw some names out there, the Shells or the BPs or one of the Exxon or Chevrons? What sort of companies should people be looking at?
So I'll take the last one first. My interest has been in the offshore companies, service companies, the drillers, because whether we go to the world of $140 oil or $70 oil, Dorothy, we're not in Kansas anymore. We're not going back to $60. That's not going to happen because we all appreciate the having access to oil energy in geopolitically safe areas. For instance, it blows my mind. You were talking earlier, I was chuckling to myself, reminded me of something I read yesterday. I think of Australia, and I just think it's like you're one big pile of commodities. It's the way I look at it, right? And I'm like, you got all these commodities? Like, what happened to you guys? And now you're running out of energy? Like, talk about screwed up priorities. It's like, huh? You should be like the OPEC of Asia, right? Like, what the hell happened, right? Talk about malinvestment, okay? So, um, I think we're going to see increased exploration activity. As you know, energy is what 5% depletion a year, give or take. You know, we lose, we have to keep drilling for more. So, and again, an old chestnut, you want to invest in areas that have seen underinvestment and avoid areas that have seen excessive investment. And so, I was reading something the other day and I went to write, I couldn't believe it when I first read it, but I double checked it. This whole hyperscaler AI thing, I'll say this just to stir the pot. For what? So we get something which is like a little bit quicker than a Google search. Like, are you crazy? We're spending trillions of dollars, okay, which is more than, in real terms, all the money the U.S. spent on railroads and highways. For what? And it's been shown. There's a great graph. I'll send it to you from Peter Berezin, a bank credit analyst. Growth sounds exciting, but it's also true. You look at it. He has an index of companies that were the biggest spenders, the biggest investors. They've done horribly over time, horribly, because you don't want to go into industries where everyone's chasing the same pot of gold, no pun intended. All right. So you've seen, as you know, and I don't have to tell you, the resource sector has been starved of investment the last, decade or more. And meanwhile, they're going to spend over $1 trillion in data centers next year. So I think to answer your question specifically, things like Schlumberger, keep it simple, stupid. Okay, like there's going to have to be more drilling, more activity. It doesn't have to be some obscure drilling company, Danielle and George. I don't need that. I think Schlumberger already. I mean, I haven't looked in the last couple of weeks, but as of we got lucky on the rotation to energy stocks end of last year. When I made this comment a month ago, Schlumberger had outperformed Microsoft, I think, by over 100% in the prior 5 months. So it's already happening. It's not like I'm making stuff up that might happen. The market's already starting to see this. And so to come back to your question, the big boys will do so well, but honestly, with what's going on with the oil price right now, I don't know. I mean, I've never seen a situation so screwed up. This is arguably far worse than any the supply shock the world's ever seen. And so I could see oil spiking to God knows what numbers in the next few months. Equally, though, with the midterms coming up, I'm sure there's a lot of deals being done behind closed doors to keep the price suppressed. So, I think the price of oil is too low, but that is small beer in comparison to the bigger scheme of things. But thing I'm pretty certain of, we're gonna have to have a lot more drilling activity. You mentioned a few minutes ago, ESJ is dead, along with ESG. A lot more drilling activity, a lot more exploration. So the Schlumbergers of the world, Tidewater, Valaris, all these things, Valaris got taken out. I didn't do incredibly well. The major oil stocks, the ones that have decent dividend yields, they should do well. But let's keep in mind, those stocks trade as proxies for the price of crude. The good thing about today that we're recording this not 2 weeks ago, a lot of those stocks have gotten shellacked already because supposedly we have peace. Neville Chamberlain, please call your office. And we don't have to worry anymore. We fixed that. Even though I think we've announced a truce now. It's like every Friday we get another truce. Okay, so I'm glad we fixed all that. But but I digress. So you know, oil could go up a lot from here. It may not. I don't know. That's not really what I'm interested in. Like, I just think drilling activity is going to be have to be sustainably much higher. I think the gold price is going to be much higher, and with that as well, gold stock. I used to say it before, the price of gold, everyone sees on the screen. I don't want to tell you where I think the price of gold could go, but I will tell you right now, just based on where we are, gold, I don't know where it closed. It was like 4,800 when I looked at it yesterday. Most of the major miners, they announced their fourth quarter, their most recent quarterly results. That was with gold at 4,100.
Mm,
Gold's 4,800 now.
mm,
You got stocks, first rate stocks, SSRM, go look at my Substack. I wrote it up. So it's like 7 times earnings. I didn't say cash flow, I said earnings. And they're
mm,
buying back stock. It's got enterprise value like 6, 7 billion, and they're buying back like, and they have cash of like equal to 25% of the market cap. They're going to buy back 10%. Like, it's crazy. So I can give you the big picture narrative, but when it comes down to what are you paying for these things? 6, 7 times earnings? You crazy? So there's a lot to do here, which gets into bigger themes. Dispersion. There's things you definitely want to own. We've touched on a couple of those, and there's a lot of stuff which just looks like vastly overpriced rubbish. And I would short the hell out of it. And so on any one given stock, sure, it can go up on any crazy quantum computing stock can go up any week for any reason. But I can give you, and I put in my paid Substack, I think a list of like 10 buys and 10 sells. You put that trade on, don't come back to me next week. Come back to me 6 months from now. Not investment advice. I'm highly confident that's going to do incredibly well. So, long the gold miners, long the energy stocks, long an electric car company, 1.4 trillion market cap. It's going to have declining revenues for the third consecutive year. Short DoorDash, short Freshpet. I mean, there's so many shorts out there.
mm.
But it's all about liquidity. So market go up. You saw what happened the last couple of weeks. I mean, the most shorted basket from Goldman Sachs was up like 20%, I think, in 2 weeks or something like that. But year to date, hey, if you had this positions on I'm talking about, you're doing just fine. So I think, hopefully we'll do another interview 6 months from now, 12 months from now, and we'll come back. I think the good stuff, I think is going to outperform the garbage by a country mile. And as a professional investor, that's what I'm trying to do. Focus on the dispersion and the rotation in the market, trying to call the market as a fool's errand. Just go back the last few years, up until last year, the market was doing one thing. But if you own the hyperscalers and the AI plays, you're up a gazillion percent. Forget about the market's doing, right? Now it's the opposite. A lot of these tech stocks, they've rallied, but they're still down year to date. A lot of these mining stocks and energy stocks, they're up 20, 30, 40, 50%. So the first shall be last and the last shall be first, if that makes any sense.
Absolutely, George. I'm mindful of time, and I think we'll have to have another chat at some stage. It's been amazing. I know we.
Danielle, what do you mean you're mindful of time? As they say what was it? Use can't leave. Keep going. Go on. Use can't leave.
Oh dear, these stories of Australian.
No, we have to stop meeting like this. We're going to do this again. Just let me know when.
Okay. Um, yes, so many stories. When you said the Australian market was only 4%, I don't think people realize in Australia when you're broking in London and you're ringing in a London, huge investment and you go, hi, it's, Danny from wherever talking Aussie stocks, and they're like, no interest.
I mean, Daniel, let me ask you a question. Like BHP, Rios, these things are like 100 billion market cap, 200 billion market cap, some number like 50, 100, 200, okay? You got an electric car company, Tesla. There, I said it, okay? This thing has made 38 billion since it's been in
Yeah,
existence.
yeah,
All right. The business is imploding. It's worth
yeah,
a trillion four. And
I
then
know.
you look at, BHP and Rios, how many people they employ, the cash flow, et cetera, et cetera, et cetera. Like something's not right here.
Well, it looks to me like I'm the first one to admit I believed in the Tesla story, but have sold it years and years ago. I mean, I'm not even going to comment on my view on the stock and what's happened to that whole company. But I would say there's cult-like behavior going on in markets, and that's the problem when you get religious, zealous, or however you want to frame it, cult. You fall in love with a stock, which you just can't do. You can never fall in love. You can have the best company in the world that does really, really well, but even the great companies have come up a crop of through disruption or change. And I think that's as you said, what Peter Lynch said, you have to know what you own. Know your company. So when you go through these volatility periods, you know with certainty that they're still doing X, Y, Z. They're still producing cash flow. They're not going to go belly up or, because you and I have seen so many companies just disappear, which we don't see as often anymore because of all this liquidity. But ultimately, what people, and I know I get freaked out, is by the valuation changes. You're either getting valuation expansion or valuation, shrinkage. They're derating it. But if the fundamentals, as you say, are okay, then you should technically be able to ignore the volatility and sleep well at night. Anyway, my
I'll
little,
tell you one last story on that. You set me up. I'm sorry.
all right.
The first stock I ever recommended at Fidelity, I went to pitch it, and Peter Lynch buys 10,000 shares. It was a retail stock. Came to find 8 years later, he always bought 10,000 shares of the first stock that any rookie analyst gave him. Okay. So a month or two goes by, and the stock falls 15%. Uh-oh. What happened? It was inclement weather, and sales were terrible because they weren't buying apparel, whatever. So like, oh my God. Oh my God. I'm finished. My career's over before it ended. My first stock is a disaster. So I go in his office. And by the way, people ask what's like working for Peter. The reason I say Peter's the greatest of all time, different investors have, each investor has their own method. Peter was probably the best analyst I've ever met. He could take any company and analyze it, keep it, KISS method, keep it simple, stupid. So my friend Danny said, George, you better go talk to Peter about it. Better you should go in there than he comes in looking for you. So I go in and I was like, Peter, blah, 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 blah. Stock's down 15%. He goes, I go, it rained and there's nothing wrong with the company. It's just sales were bad for last month. He goes, you talk to the company? I go, yeah. He goes, that's great. What? You just lost 15%. He goes, no, that's great. It's fantastic. What are you talking about? He goes, well, we get to buy more at a lower price. We're going to take advantage of the stupidity of Mr. Market. And the problem, one of many mistakes investors make, in my opinion, is they result on price,
Mm.
as if price is the ultimate arbiter. It's not the what, it's the why. Why did the GDX go down 40%? Or why did the silver price collapse, price of paper silver collapse? Well, did the fundamentals change? Or is it maybe that some of the GCC countries are stuck for liquidity and they have to sell what's most liquid so they blow it out, right? So I urge everyone to focus less on the what, number go up, chart looks good, this, that, whatever, and more on the why. Because if you understand the why, that will inform how you should view the what. And so, for instance, SSRM, which is a stock I really like, I wrote it up in my Substack. Stock went from, I don't know, mid-30s down to 25. And the gold, it's being traded as a surrogate for gold, right? 25, it's like 5 times earnings. You crazy? So unless you think the gold price is like heading a lot lower, you should be happy it went down, not upset. It bounced promptly to 35. I think it's like 31 now or something. I lost track. I don't know where it is today. So again, know what you own. And it's not about being in a Discord room and the chart looks good and no, no. Know what you own. Good old fundamental analysis. And that's where I think we're headed, Danielle.
Fantastic. Okay, George, gonna have to wrap it up. Um, Briefly, where can people find you? Do the quick spiel.
The quick spiel, Substack, we have free and paid. There's a lot of good content on the free. We started paid a couple months ago. We have 11,000 followers. New product, though, which I'm going to give you a freebie. Started a second Substack 2 weeks ago. You're going to love this one. Danielle, do you find yourself overwhelmed with too many Substacks? It was too many podcasts, too many podcasts?
I have a few that I listen to when I'm not busy writing and
So
reading lots
there
of.
are hundreds and thousands of podcasts out there. So we've come out
Oh,
with a
it's
new
too
product
many.
2 weeks ago. I believe there's value in aggregation, curation, and annotation. So what we do is we pick out like the 10 best podcasts that we think are important. We don't just give you the transcript because that takes a lot of time to read. We train the AI to ask the right questions, and so the output's only as good as the input. So we give you a one-page summary that you can read in 60 seconds. So there's a Reader's Digest executive summary version and Cliff Notes, if you will. And think about that for a second. You Do 10 of those a week. So instead of 10 hours, it's 10 minutes. 4 times a month for a month. 40 hours gets reduced to 40 minutes. It's free right now. It's podcast week, named after Wall Street Week with Louis Rukeyser, which I was a show on when I was young and good looking. Podcast week on Substack, in addition to the Noble Update, which is on podcast, this is on Substack. It's free for now. That's going to come out. It's going to go to a paid form in a couple of months. I think that's going to be indispensable. I expect we're going to have millions of people paying a ludicrously low price. It's going to be $9.99 a month. So democratizing finance, I'll land this plane. The conference we had a month ago, it's another thing you can find me. We had a conference a month ago, 15 thought leaders, guys like Michael Howell. We had Michael on our conference last year, but this was purely stock picking. 15 guys, 20 minutes apiece, $99. These were put on by guys who are typically charging $10, $20, $50,000 a year for institutional clients. So online, you can watch it on replay. It doesn't get any better than that. So $99 for that is crazy. So I want to help people, and we're kind of making the price so low that you can't say no. So you can find me on Substack. I have two Substacks. I have 98,000 followers on X. I'm on YouTube. I'm on Spotify, all these places. I like to talk. It's great people listen to me. You're putting up with this nonsense. But markets are changing, and I think, rather than just being the umpteenth guy to talk about the shiny object du jour, whatever it is, we have a piece, we don't have a piece, whatever, keeping things in perspective, looking at the big picture, but most importantly, not just bloviating about global GDP and my inflation forecast is better than you. No, 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 no. How do we make money? Information comes in three types: descriptive, what has happened; predictive, what will happen. I think interest rates are going to go up, for instance. And then prescriptive, what do we do about that, George? Do we short bonds? Do we short housing stocks? Do we buy gold? Whatever. And too many people out there focus on the descriptive because they're journalists. They don't know how to do financial analysis. You unfortunately do. But the real value add, what people want is, how do I make money? What do I do in my portfolio? And that's what I'm trying to solve for. I make tons of mistakes, but I'm honest, I'm hardworking, and I've got some gray hair. And did I tell you I work for Peter Lynch? So there you go.
And you also have an amazing Teledex of contacts. I see it
There
on
you
it.
go.
George, we'll put those details in our piece. So we're going to publish this as a YouTube, but it'll also be written up for FNArena subscribers and also non-subscribers. So George, thank you so, so much. Fascinating conversation. I feel like we have hours of stories and hours of things we can discuss about markets,
Oh,
but
for sure.
this is, for now, this is it. So thank you very much for joining me.
Thank you, Danielle. It's been fantastic. My real pleasure.